Hello and welcome. You're with the Derivatives Show. The basic rule of investing is self-awareness. And once you decide your capacity for risk, the derivatives market offers multiple choices for every investor. Today we're going to discuss some basic strategies to get you comfortable with options. Let's start with vanilla options. Puts and calls. Jitendra Panda, business head broking at Capital First, is our expert today. Jitendra, good to have you with me in the studio. Let's start with calls first. If you're going out to buy a call, what is the view that you should be certain of?
See, when you're buying a call, basically you're bullish on the market. Your view is that the markets are going to go up. Now, why you're buying a call? Because yes, I want to limit my risk. Here's an instrument which controls your risk, and I am paying only the premium amount. If the market doesn't go up the way I envisage, I lose only the premium. So that is where your strategy begins with. First, you have to be bullish, and you should be able to pay that premium, whatever is the market quoting at. So that's how you start off in the market in the call option.
How do you make a strategy? Because every day you come up with new strike prices which the exchange offers you. There is implied volatility to be considered, time value which decays closer to expiry. So when does a person who is bullish on an underlying, be it a stock, be it an index, be it a commodity, decide that this is the time and the price that I should be paying for this particular call?
First, when you're buying, you're looking for bullish, you should have also a time frame, because all options have a time frame. So within that time frame, the market should move up or reach to your target levels. Now coming to your target levels, you yourself are a buyer. I mean, if you are a buyer, you are going to set the targets. I mean, I believe that, say for example, Reliance is at 900, and you believe that in the next 10 days, 15 days, Reliance will move up by around the 20 rupees or 30 rupees. So you have set a target that in next 15 days, 30 rupees is my upside on Reliance. So now you need to buy. You cannot go and buy a 930 call option. You cannot go and buy a 950 call option, because your target is only 930. So you will have to look anything below that. I mean, so that you are going to make money if the market moves the way you thought.
One thing that, if you bought Reliance at 900, your expectation is that it's going to go to 930. So you're playing for that 30 rupee increase. When do you decide that, listen, maybe my call option, this is the right time to retire it, because it may reach 930, it may be short of it? What is the break even, the profit point that I should always keep my sights on?
After the first step, which we just discussed, the targets and all that, you enter. Now you need to know before you enter, another thing is, what are my break even points? So for example, you have bought a 900 call option and you're going to pay, say, 15 rupees the premium, and your target is 930. So till 915, if the market expires on the last day at 915, you're going to get your premium back. If it expires at 920, you get 20 rupees. It expires, you think 930, then you're going to get 15 rupees as your profit. 15 is your cost. So break even is what? Strike price plus premium what you're paid is your break even point. Now 15 rupees is what you're paid. Now you have to keep your stop losses also. I mean, you cannot be always right. You are bullish on the market, but then things may not go the way you envisage. Markets have their own way of reacting, the way they will do what they have to do. So you need to keep your stop loss. You're paid 15 rupees. You need to see that if the premium, say, comes below 10 rupees or maybe 7 rupees based on your risk appetite, you keep your stop loss. If that comes, I will exit, because something is going wrong. Something is going wrong, market is not moving.
We talk a lot about buying calls, but what about the other end? If there is a buyer, there has got to be a seller, a call writer. Tell us a little bit about what profile they should have, what is their risk appetite, and how do these various factors play out for them?
The call writer or the seller, what we call, he will get only the premium. That's his maximum profit. I mean, in the example we spoke about 900 call option, that 15 rupees what the buyer was paying, the seller will get that 15 rupees, and that's his maximum profit. And he has unlimited risk, because Reliance can go to 950, 900, 1000. I mean, nothing can stop it from whatever it has to do, and can go anywhere up. And so unlimited risk potential. Now the question arises, why does he sell? If the buyer was bullish, this guy is bearish. He believes that the chances of market coming down is very high, and he wants to pocket the straight away the money full. I mean, the 15 bucks, and he knows I want to make minimum. Even if the market comes to 800, he is going to make 15 bucks.
Okay, let's come to puts. Now, a call implies that you're bullish if you go out and buy a call. If you're going ahead and buying a put, clearly you are bearish. What is the view that you need to keep in mind, and how do you apply this strategy?
what holds good for a call buyer, everything holds good here also. You need to have your targets, you need to have your stop loss, you need to understand your implied volatility. So all these things holds good for a put buyer also. He's just the difference is that instead of a call buyer where he's bullish, here he is bearish, and he's taking a limited risk, and the market comes down, he makes money. I mean, theoretically, yes, I mean, in a call buyer, there's unlimited profit where the market can go anywhere. In case of a put buyer, you know, you can say that the stock price is only, I mean, it can't go below zero.
Where should a put buyer put his stop loss if the market does not actually take that direction which he has bet on, which is a bearish call?
Whenever you buy a put option or a call option, you need to keep your stop loss, one, on the value wise, second is on time wise. In 5 days things doesn't happen, then you know you should exit. You should exit because things are not moving the way you envisaged. And a lot of people do practice this, and I've seen them succeed fairly. You know,
Okay.
That's what I would say.
For a put writer, what is the maximum extent of risk involved? And clearly they are willing to take a higher risk because it is the buyer of calls and puts who has the right to, you know, end the contract, but does not have the obligation to go through with any of the restrictions on it. For a put writer, how would you approach it?
The way, I mean, the call writer is there, similarly the put writer, he is taking unlimited risk. I mean, and the stock price can go down, and there could be, you know, very bad news in the market, or for the stock specific, whether it's Reliance or whether it is SBI or whatever stock he is writing on. So he has risk. He keeps a stop loss. I mean, based on, he has sold at 15. He may say that, okay, I'm ready to take a risk of 10 rupees. I mean, till the premium doesn't go to 25, I will hold on, otherwise I can cut. He can exit during the market hours, you know, and restrict his losses to 25 till the premium becomes 25. And then he exits and moves shifts his position to somebody else. So there is a stop loss also maintained by the writers. But the idea most of the writers do is that they wait till the expiry.
Right. We're going to take a quick break here, Jitendra Panda, but stay with us. The BSE Derivatives Show comes right back after this break. Welcome back. Straddle and strangle, these are two popular option strategies. For both the straddle and the strangle, you need to buy the same number of puts and calls with the same expiry date. Well then, what are their differences and how do you decide when it's right for you? Jitendra Panda tells us more. Jitendra, let's start first with straddles. What exactly is a straddle?
Straddle, as you define, is that you buy simultaneously call and a put of the same strike price at the money and same expiry. So the idea behind is that if the markets are very volatile, expected to be very volatile, you don't know which direction the market or the stock will go, you know, based on the results or based on the election outcome or the budget outcome. So from there at the money, the market will move up or move down based on the outcome of the whatever event it is.
Right.
And then you benefit out of it.
Okay, let's start with long straddles. Obviously, all straddles are intended to minimize your risk in a volatile environment. What is the maximum risk that there is for an investor if he should go for a long straddle?
See, when you're buying a long straddle, that means you're buying call and a put. So you're paying premium at the money. So both the premium together, and market doesn't go anywhere. You bought because you expected to be volatile. So the total premium paid at the money and the market expires at the money itself at the same level. Your maximum loss is the total premium paid.
Okay.
So to buy the call and put. So that's some loss you can have maximum.
Okay, Jitendra, now explain this to us. If you're waiting for an event like corporate earnings, they come 4 times a year and it's usually an event which takes longer than a month to play out. If you've taken a long straddle, which means you hold a call and a put at the money, how do you book yourself or hedge yourself against risk so that you have the maximum profit?
The idea when you do a long straddle, that means you're expecting market or that stock price to go either up or down, and a volatile, highly volatile, either up or down. Say for example results, maybe Infosys result. So I mean Infosys result is expected on 10th or 12th or whatever the month of the result season. So beginning of the month or in mid of the, before the results come in, you buy because you don't know the results are good, or Infosys may move up by 200 rupees, or in bad it can come down by 200 rupees. So at the money option, you buy a call at 50 rupees and buy a put at 50 rupees. So the total cost for buying call and put for this straddle is 100 rupees.
Right.
Now your break-even point, say for example Infosys at 2,500. So now 2,600 upside and 2,400 downside. Within this range, if the market remains, you have a loss in your hand because you're paid 100 rupees. It has to go beyond 2,600 or below 2,400. Now the results come. Say if the results is good, and Infosys moves to 2,800, now you book profit on your call option because you have made $300. You don't worry about your put option because that will expire worthless, because it would have already come down to say 5 rupees or maybe much lower than that. Now it's at 2,800. But in case it has the result is not as per expectation of the market and it comes down, say it comes down to 2,350, you book profit on your put option.
Okay. Tell us, since there is a long straddle and a short straddle, simplify it for us. What is the difference between the two, and when do you decide that you're going to take a short straddle? Because in both strategies, you're going to be buying the same put and the same call with the same expiry. You'll just be booking it at different points of time.
In a long straddle, you're buying call and a put. In a short straddle, you're reversing. You're selling call and a put at the money option, same expiry and same strike price. So when you expect market to be volatile, you go for long straddle. When you expect that stock or the market is not going to be volatile, you sell straddle. So when you're selling straddle, you get premium because you're selling a call and a put of at the money.
What would you advocate to a viewer? Because at the beginning of any month, the contract month, time value is at its highest. Now, if you have a view that for the entire month, there is not going to be too much volatility in Hindalco, would you ask the viewer to, or the investor, to pay a higher premium at the beginning of the month? Would you ask them to wait? Like you mentioned that, the last 2 weeks or so are more favorable to buyers of calls and puts. The first 15 days are more favorable to writers if you're going in for, say, a short straddle.
In case of a straddle, if you're going long straddle, it's only for an event. I mean, results, as I said. So if you're looking for a result and you expect results will have an, explosive impact, either upside or downside, then only you go ahead, because you're paying a huge premium and the market would have already priced in something, and the implied volatility will be very high, the premiums will be already very high.
Yes.
So you need to look at your break-even points very carefully. Is post result or post the event, whatever is the merger or is there announcement or anything, will the price move beyond those range, your break-even points? Now, if that is the case, then you go for long straddle. Otherwise, in beginning of the month, if you know the stock is not going to move another next 15 days, then you go for short straddle.
Jitendra, just to reiterate the point, stocks which have a higher beta, which is mid caps, small caps, by and large as a basket, what strategy would you approach those stocks with? And stocks which have lesser volatility, which means a lower beta, they move in tandem or closer to the index, what strategy would you adopt on those?
See, stocks which have very high volatility, I mean, and if there is an event, adding to it, so there we go for long straddle, because of course we will have to look at the implied volatilities and the pricing, as I said, the break-even points. That is where you need to go for long straddle. Stocks which have very low volatility are working with the market, and markets overall are not very volatile, then you should look for selling the straddle where there is an opportunity, although you have risk, as I said, in a short straddle, but then you have an opportunity also.
Jitendra, like we have straddles where you buy the put and the call at the same price, which is at the money for the same expiry, you have strangles, but in strangles you opt for different strike prices. Jitendra, please go ahead and explain this to us.
You buy out of the money call option and you buy out of the money put option on the same day with the same expiry. So you're buying on one single day out of the money call and out of the money put. Now, why you do that? If markets are very volatile, the call option which is out of the money will become at the money, or in the money if the market moves in that direction. So you have chance of making money, and your outflow is low because you're buying out of the money option. So premiums are low. So your risk is low if the market doesn't move. So where you believe that the volatility will be there if the event is very big, or if not, then you go for strangle. So difference between straddle and strangle is there, but then it's basically on the risk.
In terms of risk and reward, if the risk is limited or reduced in strangle, what about the upside, the maximum profitability that you can have here?
In case of a strangle, long strangle, you buy a call and a put, and you're expecting market to be very volatile and your risk is low. So naturally, your returns could be also lower if the market's volatility is not very high. If it's very high, you will make money, but again, from difference between if you had bought a straddle, your money would have been much higher. Could be possible when the markets are very volatile. So at what different strike price you are buying? Generally people buy a little out of the money, so that the premiums are low, risk is lower. So if say for example, Reliance is at 900, they would go and buy a 920 call option and an 880 put option. So that's how they would like to do, and the market has to move beyond 920 and 25 because the cost will be 2 rupees, so 5 rupees each. So 925 is my break even. So that's how the difference is, that the returns could be a little lower, but your risk is also low.
For a short straddle, what should the investor's mindset be if he decides to go for this strategy?
Now, in case of a long strangle, as I said, volatility. In case of a short strangle, you are selling out of the money call, you are selling out of money put. Same example of Reliance. I expect Reliance will not go above 920 in the next 15 days. And I do not expect it to go below 880 also. Current price is 900, say, for example. So what do? You sell the 920 call and you sell the 880 put. You get lower premiums, you get smaller premiums, but then that is where you're pocketing. Answering to earlier question, who are the sellers? These are the sellers who believe that they do not see 920 or 940 on Reliance, so they will sell those call options. So they will, and market will go any one direction. So even if the risk comes, it will come on the call side, not on the put side. So the money is covered at least one side to take care of the risk.
Okay, so that was it about strangles and straddles. We'll take a break. The Derivatives Show comes right back. Welcome back. You're with the Derivatives Show. If you're moderately bullish or bearish on the markets but don't want to invest too much as far as premium goes, well, you have the choice of sharing both the premium, that is the cost, as well as the reward. Bull and bear spreads could work to your advantage. Let's get in Jitendra Panda of Capital first to explain this to us. Jitendra, let's start with bull spreads first.
If you're moderately bullish and you believe that in the next 15 days, say for example, Reliance is currently at 900, for example's sake, and you want to buy a call option. Now, if you go and buy at the money call option 900, say it's at 20 rupees. Now this will mean that you have to take a risk of 20 bucks. Now, here is a strategy where you need to work, which is called bull spread. It's a vertical spread, wherein you buy at the money call option or in the money call option and sell out of the money call option. So what happens now in our example, in 900 call option, which was at 20 bucks at the money option, which I bought. Now I go and I believe that since I'm moderately bullish, that Reliance may go up to 930. Now why should I pay 20 bucks? I would like to go and sell the higher call option. Say a 930 or a 940 call option, which is if it's available in the market, and I go and little higher out of the money, whatever is next available, I sell that. I'll pocket some premium. Say for example, I get out of that, say 5 rupees. So I reduce my premium cost by another 5 rupees. So that way my break even point also gets reduced. The market goes moderately bullish and it's up, Reliance goes up moderately, I still pocket money. In case it goes to 950, I will share, I have to pay that other gentleman who has bought from me another premium some money, which I would have already got money from 900.
What is the breakup of this cost as well as the sharing of the reward? Because of course the person who chooses to go in for the bull spread, he gets to decide when he would like this option to expire, when he would like to opt out of the contract. What is the extent to which they can divide the premium? How much is the maximum that they would have to pay, and how much of their reward would they have to proportionately share with the other party?
When you're doing a bull spread, as I said, you buy at the money call option or in the money call option and sell the higher strike price call option. Now when you're buying and the higher strike price, if it is achieved before expiry, the higher strike price, you exit both the option and pocket your money, because you don't want to wait. You don't want to wait again the price to come down. The stock market can, the Reliance price can come down in our example. So, and I lose the opportunity of booking profit. So you need not wait it to cross. So you enter at a price which at the money option 900. Reliance moves to 920, 925. You have sold suppose a higher strike price. You wait till that strike price, the price comes or closer to that, your profit is maximum profit, because your maximum profit is nothing but the the difference between the two strike price and the premium paid.
For a bear spread, how would you advise investors to approach that one? Of course, we've said that if you are moderately bearish, a bear spread is what you can opt for.
Here is a strategy where you can do, it's called a bearish spread, where the risk is very low because you're buying at the money or in the money put option and selling out of the money. The lower strike price. In case of put option, you buy at the money and lower strike price because it will be out of the money. So when you sell that, your risk is low, but here is an opportunity to make money when market goes down. So I would say that this is an opportunity to do bear spread and try out to make money in the downside market also.
Jitendra explained to us, since time value is really of the essence, with any event and also of such relevance to options, how does it work for bull spreads? At what time does it benefit the purchaser?
See, if you're going on a long bull spread, okay, and you're buying with call options, okay, now if you're going to buy in the beginning of the month a call option, you're bullish on say stock like Reliance, you're bullish and you're buying a call option. Beginning of the month, you'll have a lot of time value, and which will erode if the Reliance price doesn't move in the direction which you envisage upside. So what happens? You will lose the time value. To overcome this, to mitigate this risk of losing out on the time value, bull spread comes very handy. This strategy is what, as I said, that you buy at the money call option or in the money and you sell out of the money. There also you compensate. You're covering your time value, some part of it, from the other a buyer. You're selling to the out of the money call option, so you're covering some. So you're mitigating that cost, that risk, because you're lowering your premium cost. So now you have more time and lower cost to recover your money. You get with the current value till it doesn't come at 10 rupees, you can still hold on.
And for a bear spread, how would time value work in the favor of the investor?
The way it works for the bull spread, the bear spread also, I'm moderately bearish, and that's what I would like to take a step on, which most of the viewers, as I said, don't do. Now I'm taking a step. Now there also time value is there, and then I'm generally I'm jittery. As a human, as I said, psychologically going short is not my cup of tea, or most of the people, investors we have experienced. So here is a playing bear spread and not losing a lot of money. You can work on those. That's how in a vertical spread helps you, and that's why, as I said, it's a very popular and should be tried out by investors, because the risk is lower and your returns could be also lower, but then you can play the game and enjoy the game.
Right, Jitendra, thanks once again for taking us through the basics of strategies in the options market. Thank you for having been with us on the Derivatives Show.